Hi, I'm Peter Rose, founder of Longwood Currency Trading. Thoughts on Forex testing process. This is a pretty controversial topic in the video space out there and in the literature, and it concerns me that a lot of the folks that are proposing doing Forex testing are really giving bad advice. The bad advice is testing a system as opposed to a strategy. A system is, when the RSI bings this and this level is crossed and it's Tuesday, you're going to take your trade. That's a system. I'm looking at this engulfing candle pattern, and when this does this and you count 4 bars back and set your thing here, that's a system. Systems are no good. Systems don't create a trade. Systems are the result of proper trading. Systems change all the time. That's why you see so many people, not only in the Forex market, but also if you watch stock channel, trading channels, or commodities or whatever. Oh, the market changed and I had to change my strategy. I think it's a strategy, it's not, it's a system. Behind a strategy is the knowledge of trading itself. So you have to know how to trade, and trading is done without systems. People who are weak and don't really understand the process of trading and who haven't done their homework want to abrogate their responsibility for doing their work onto a system. Oh, I'm trading London Open and it doesn't work for me, so I shifted and went to the, Bob's Dance of Death system. So when you're going to test something, be sure you're testing the right thing. Test the strategy, not the system. Well, what's a strategy? Well, your strategy could be in the last, 15 or so, 20 videos that I've put out. I'm at something like 360 videos or 370 videos right now. But in the last 15 or 20 that I've put out, I've discussed issues of building positions and staging. Not things to be done by beginners or people that are short stacked and are not trading with a large multiple lot size and not doing it at 200 to 1 leverage. I mean, all these factors have to be laid out because those are the ground rules of the game that you set out for yourself as a strategy. Those are ground rules that I have. My strategy is not to trade at 200 to 1 or 500 to 1. My strategy is not to rely on RSIs or friggin' fib levels or all that stuff. My strategy is to rely on price action or what it's telling me is going on right now and doing a comparative analysis of what it's doing right now with what it did in the past. But not looking at flag patterns or head and shoulders patterns or anything like that, because those don't exist any more than you can see a pattern in the cloud. Oh, that cloud looks like an elephant. And, well, I've seen that cloud before, and it looked like an elephant, and it rained. So now I'm seeing this cloud that looks like an elephant, and so it's probably going to rain. It's crazy. So if you're testing against stuff like that, you're going to get crappy results because you're testing the wrong thing. And that's giving you the wrong conclusion about what you should be doing in your trading. So you have to be very, very, very careful. Well, the question then comes up, the only thing you can use Forex testing software on or for is testing a system. Well, what would I do if I played a golden cross of 8 cross 25 either side? That's a system. And you can run a testing scenario out on that. And you can cover 10 months worth of trading time. You can cover an awful lot of permutations of price action against that golden cross system. Of course, the problem with that, if you don't recognize it right away and doing something like that, is you're not trading 24 hours a day. you're only trading maybe for an hour or two after you get up before you go to work, because most of us got to work. I don't have to work. I'm retired, but that's okay. I'm not going to trade all day. Don't want to trade all day. I'll spend an hour or 2 hours, and I'll make my decision as to what I want to do. How do you write a program to test for that? You can't. Well, I do, but I don't do it based on this gut feel. Oh, you okay? I don't call them setups. I call them meeting conditions of a rule for trade entry. And I have 4 conditions. And I can look at the situation. I can say, if this happens, and this happens, and this happens, then I'm going to want to take the trade because of these other conditions that say that that's going to be a pretty good thing. I can write the rules down into a computer program for if this happens and this happens and this happens, then I go in. But how do you write the rule for that preliminary view that says, oh, there's a great potential trade opportunity here for me to set a profit target at this level, and then to, depending on my skill and expertise as to how I want to manage my risk with a stop loss, or if I just want to float and I'm going to be there and like I was today and just watch the thing, and I got out with the first stop loss, but I didn't want to get caught because we were running about 3.5 pips on the spread, and so I just thought that was a lot of unbalanced positioning. I was wrong this time. Yesterday I was in a position, I was $3,000 underwater, and I traded my way out of it and made $150. So you're not going to build a testing program to test trading. Now, you can have strategies that you can program for, as I mentioned. You're not going to be able to, you can easily write a program and buy a program to implement systems. In fact, that's what robots are for. They have some system lined up with a bunch of contingencies and issues and stuff, and they work great. They work great until they don't start working so great, and then the number of errors goes up exponentially. It isn't just like, oh, the robot sees a problem and it shuts the trade off and it goes in and it doesn't, because the market changes, the price action changes off away from the parameters, and the robots, the way that you program them, are to look for certain characteristics and it will see the characteristics that indicate to take a trade. And it will do that so very fast and lose a lot of money. And if you're managing multiple positions over multiple currency pairs or stocks or whatever you're doing, then you're dancing to the same rule set, so it's reacting the same way on every one of the positions that you've got the robot running on, because it's running against a system, and it doesn't work so good. You have to have a human behind that in order to manage the position, not only from a risk standpoint, but also from a profit standpoint. You get to the point where you're watching this stuff and you become very familiar with what price action is doing. The price is moving in your direction, and all of a sudden there's this anomaly in conditions that the price starts doing something that you recognize as building in momentum. You pull your stop, your profit target limit stop off, and you just run that son of a bitch and let it go. And then now you're building a staging program to stage into that position with more lots based on a strategy that you have developed for when that particular type of occurrence happens. If you were doing that under a robotic environment or a testing environment, you'd be staging in, I'm going to stage 2 more lots in at each hop of 5 pips or whatever it is that you're going to do. But you can't do that because that's not how you trade. You're not looking at the price action as a singularity. You're looking at the price action as a continuity of what's going on in the past, because what's going on in the past is order flow. And the order flow is building like ocean waves build in order to create a cresting ocean wave that you can surf. Or you're doing the same thing, and now you're on this cresting, surfable price action, and you want to get in there and start throwing more lots against it, but you have to be very careful. What's the dynamicism of that particular momentum move? When was the last time that happened? Is the trading basically in a chop, a range, or are you in a trending environment? Where are the structural significant levels that you need to watch out for as this price is accelerating forward? Because the faster it accelerates forward could indicate a fast deceleration in the price, and that's called a pin bar. So you have to be very, very alert to when you're building your strategies that you don't confuse your ability to test the strategy, because you're testing the system, unless you write your own programs. I'm able to do that. I've got a 33-year career as a senior software engineer, a bachelor's in physics, almost a minor in math. So I can write the more exotic, and I don't write testing programs. I write simulation programs. And the programs don't simulate trading against flag patterns or indicators or systems. My programs work with strategic concepts as to what would be the probabilistic characteristics of this configuration of movements given this particular type of price action. So you have to force in the price action. For example, if you're trying to work with a staging model that you're trying to test, you wouldn't want your simulated price to be in a range-bound process. So you would write the programming so that the price action was in a continuous, let's say, upward direction in a trend. Then you'd have to make the decision as to how much volatility you want to apply to that trend. And also the pullbacks. What are the probabilities of the pullbacks in the price action? So you're not only writing code to simulate the market environment, but you're also writing code to build strategies, test the probabilistic validity of the strategies that you've programmed in against that particular type of price action. And then once you've done that and you've established pretty good guidelines for how that strategy should be executed, you then run that same strategy against a range-bound system and see how it works out. If it doesn't work out, then you shouldn't be using it, because you're never going to be able to tell when the trend ends until it's too late for the system or the ingrained rules that you've built for yourself to change in time not to be caught by that. So be very, very careful that when you're testing or you're doing probabilistic analysis, that you are not confusing doing it against systems as opposed to where you should be doing it is against strategies. And those are two really different things. I hope I explained myself clearly, because I don't see anybody out there that really differentiates the difference between a system and a strategy. Although you sort of assume that in the language that you're speaking, but a lot of people aren't educated enough really to know the difference. I see a lot of people talking about trading against mean reversion, and that's not true. We don't trade against mean reversions. You trade against a mathematical concept called regression to the mean. Mean reversion is an accounting process for statistical evaluation of financial documents and corporate structure. Mean reversion shouldn't be used in trading. It's regression to the mean. So if you really don't understand, if you're looking at a term, you better be sure that you fully understand what that term is if you're going to be testing against it, to make sure that the term itself is valid to be used in whatever it is that you're doing. Man, it really isn't all that complex if you have somebody that can guide you and eliminate all the crap up front and show you how to build a good framework, a base framework that you can trade and make a good percentage return on your money. Not job replacement income, but a solid increase in your net worth. And as a, you know, I mean, if it's producing less than about 20% a year, then you don't want to be doing currencies, because when these things burp against you, you could lose that whole 20% just very, very quickly. You've got to be trading for the 80-90% winning capabilities on a yearly basis. Will you be able to get 80%? No, but that's not the point. You have to have a strategy that will provide the groundwork for you to do that, so that when you have drawdowns, they don't wipe you out. It's a matter of understanding what you can test for and what you can build your expectations on, as far as where your abilities should be focused on. Not only the testing, but also focused on where do your abilities lie in your trading. Do you are you particularly attuned to regression to the mean? Are you attuned to moving average sensitivity? Or God forbid you want to use an RSI, or it's Tuesday and it's cloudy out, or something like that. I mean, there's certain things that when I work with someone, I differentiate as, this is stuff that you don't want to waste your time with, and this is stuff that will get you a good solid start. It's just really basic stuff. It's like going into competition swimming. You pick a stroke and you work on that one stroke, and you don't try to swim 10 miles right away. You up and down the pool, getting your timing, your breathing, and all that other stuff right. And then when you've got that down, then you can pour on the gas and you can work on that and go into competition. Trading to replace your job income is going into competition, and if you're trying to do that on a $20,000 account at 200 to 1 leverage, maybe you'll be successful at doing that for a year or a year and a half, but eventually the luck will come out at you and you're going to lose your whole account. You'll lose $60,000, $80,000, $100,000 when that's all the money in the world you have. When if you really tested against reasonable strategic opportunities, you would be in a far better position to judge where your stop should be, the pair that you're trading, where the pullbacks are going to be on a trend, where the pullbacks are going to be on a range-bound market. You get a sensitivity for the strategy that you need to apply in order to take advantage of the price action during that period, based on what it did in the previous period, so that you get a little bit of a pre-hint on maybe this order flow that happened yesterday or 2 weeks ago or whatever, depending on the size of the movements, the amplitude of the upswings, if you're trading long, are, and how that might be able to affect what you're doing currently in this current environment. Those are things that you can write simulations against, not testing. So just wanted to make sure that I've made myself clear in all the videos that I do, because I do talk about the simulation work that I'm doing, and it's not to be confused with testing. I don't do testing, and I don't believe in testing, and I don't suggest that my students test, because if you're going to test and you really don't know how to trade, you're going to be testing systems. And I've just explained why that's not really a good idea. From my viewpoint, with a bachelor's degree in physics, almost a minor in math, 40 years of real estate investment, and 33 years as a senior software engineer. That's my background. So you can take your background and argue with me if you would like, but you do so at your own peril. Just be sure you understand the difference between systems and strategy. Forget the systems and learn how to trade so that you can use strategies. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.